For the majority of February, Brent crude prices have been above $80 a barrel. This is because there are indications that the physical market is becoming more competitive as OPEC Plus production cuts continue and shipments are being rerouted away from the Red Sea and the Suez Canal. Because tankers must travel a longer route via the Cape of Good Hope in order to reach the Mediterranean and Northwest Europe, arrivals from the Middle East are delayed by at least 2 weeks. As a result, European refiners are searching for cargoes from the Atlantic Basin. Consequently, the cost of North Sea and West African oil grades has gone up this month, helping to keep Brent oil prices above $80 per barrel and further extending the futures curve's backwardation. When there is a market shortfall, backwardation usually happens, and front-month contract prices rise relative to those further out in time. Analysts note that despite what price action and market sentiment may suggest, the wider backwardation curve points to a tightening market. In the months when global oil consumption is normally lower, decreased production and exports this quarter from the OPEC Plus producers, led by the largest exporters from the Middle East, are also helping to maintain oil prices. That shouldn't bother OPEC Plus producers too much because this month's oil prices have remained above $80 a barrel, defying earlier analyst predictions of low prices and excess supply at the beginning of 2024. However, OPEC is not solely to blame for the tighter market. Increased refining margins and the surge in the price of Atlantic Basin crude so far this year are largely due to disruptions in Red Sea/Suez Canal traffic. According to calculations by Reuters, the average margins for refining gasoline and diesel in Europe surged to $11.60 per barrel and $34.30, respectively, their highest levels in months in January. Furthermore, traders report that longer Middle Eastern crude oil journeys have increased European demand for crude oil from closer destinations, driving up the price of Nigerian grades. The leading African producer of OPEC is now selling its crude cargoes more quickly. Increased Red Sea shipping diversions are keeping the market tight since more oil is being placed on ships, which leaves less available on land, analysts at consultancy FGE stated in a report on Friday, despite the fact that global crude balances are increasing longer, seasonally, in February and March. According to FGE, there has been an increase in the rerouting of crude cargoes around the Cape of Good Hope thus far this month. The amount of diversions peaked at 1.6 million barrels per day, BPD, during the first week of February. The majority of the diversions are still concentrated on Middle Eastern oil flowing westward into Europe. In fact, 6 of the 8 shipments of Iraqi crude destined for Europe that were loaded in the first 10 days of February had been rerouted via the Cape of Good Hope, according to FGE analysts. The risks associated with transiting the Red Sea forced most tankers bringing Iraqi petroleum to Europe to sail via the Cape of Good Hope, COGH, rather than the Suez Canal, which contributed to a decline in Europe's imports of crude oil from Iraq at the start of this year. Last week, Vortex's senior oil risk analyst, Arman Azizian, wrote a report. However, according to Vortex's statistics, India's imports of Iraqi crude reached an estimated 1.15 million BPD in January, the highest amount since April 2022. Iraq is one of India's main oil suppliers, and with the tighter enforcement of the sanctions against Moscow, the third largest crude importer in the world is also trying to replace lost Russian oil due to payment concerns. The increased demand for American crude in Europe as a result of the disruption to flows in the Red Sea also supports U.S. benchmark oil prices. According to FGE, the U.S. crude arbitrage to Europe improved in late January and early February as transatlantic freight decreased and the May/Brent spread remained large. However, the arbitrage has begun to close in recent days due to the increased European purchase of U.S. oil, indicating that the current strength in the WTI futures structure may not last long, according to FGE analysts. According to Bank of America, the yearly pace of growth in the world's oil demand may have already peaked, but it will still rise for years to come. Since demand growth is returning to more modest levels from before the COVID collapse, electrification of transportation, energy efficiency, and slower economic development would all work together to constrain the growth rate in the upcoming years. As economies recovered and people resumed their regular travel and consumption patterns, there was a significant increase in the world's oil consumption in the 3 years that followed the pandemic's impact on demand. Several analysts even predicted that oil consumption will never rise to levels seen in 2019 during the height of the pandemic's depressing effects on supply. Not only has it recovered, but worldwide consumption is currently at an all-time high and is expected to set more records in the years to come. The demand for oil is expected to continue growing as demand in emerging nations rises and balances flatlining consumption in some of the most developed economies, even if projections suggest we may never see the growth rates of the previous 3 years. The growth rate has probably peaked permanently. In a recent note published in Business Insider, Bank of America analysts lead by commodity strategist Francisco Blanch stated, oil consumption will likely continue to grow into 2030, but the rate of oil demand growth has likely peaked for good. This is in response to a 2.3 million barrels per day or 2.3% expansion in 2023. The bank's strategists stress that oil demand growth should be a small fraction of the rate seen in the last 3 years, with an average of 600,000 barrels per day year over year through the end of the decade. It should come as no surprise that the growth rate is decreasing to more moderate levels given the demand upswing that began in 2021. The fact is that, even with reduced growth rates, global demand for oil will rise this decade and most likely beyond 2030, which is good news for producers and users of the commodity. The Paris-based organization, which promotes a quicker energy transition, claims that the argument for increased investment in fossil fuels is weak since demand for all fossil fuels, coal, natural gas, and oil, is expected to peak before 2030. Following this forecast, OPEC publicly chastised the IEA for its assertions that the end of fossil fuels was near last year. OPEC has repeatedly attacked the agency since the fall of 2023 for spreading the dangerous myth that supply expansion would not be necessary to meet this decade's peak demand. According to Haytham Al-Ghais, Secretary General of OPEC, such narratives only set the global energy system up to fail spectacularly in September. It would cause an unprecedented level of energy disruption, with catastrophic effects on billions of people and businesses worldwide. More recently, Al-Ghais stated that the oil industry has had a history of unrealized peaks for both production and demand since the beginning of oil exploration in an article that was posted on OPEC's website last month. According to Al-Ghais, it is evident today that no credible and solid short and medium-term forecasts indicate that peak oil demand will occur. For the combined years 2023 and 2024, OPEC projects a short-term increase in oil demand of 4.7 million barrels per day. Other analysts, including SI, predict an increase to above 4 million barrels per day, while Rystad and Argus are close to this estimate. The official stated that even the IEA predicts increase of 3.4 million BPD for the years 2023 to 2024. The Secretary General of OPEC stated that it is difficult to predict peak oil demand by the end of the decade, which is only 6 years away, given these growth tendencies. Long-term demand is expected to be strong, according to OPEC, which increased its long-term projection in its most recent annual World Oil Outlook. In 2045, global oil demand is expected to be about 116 million barrels, up 6 million barrels from the previous estimate from 2022. OPEC projects that between 2022 and 2045, the world's oil consumption would rise by more than 16 million barrels per day, from 99.6 million barrels in 2022 to 116 million barrels per day in 2045. OPEC, Bank of America, and numerous other forecasters and analysts predict that India will overtake China as the primary engine of global oil consumption growth, even as China's demand growth slows. OPEC's Al-Ghais noted that governments are reassessing their approach to energy transition pathways and that consumer rejection is the reason why peak oil consumption is not expected by 2030. The Secretary General of OPEC claims that further factors avoiding peak oil demand this decade include faster industrialization in developing nations and the growth of a larger middle class there, an expansion of transportation services, and increased demand for and access to energy. After all, crude oil and its derivatives are an indispensable part of our daily life, supplying essential items and contributing to the provision of affordable, widely available energy security and access, stated Al-Ghais. Oil has consistently disappointed predictions about peaks. History and logic both indicate that it will continue to do so. And that's it. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching, and I'll see you in the next one.